Hey, good morning, everyone. Marty Missouri here. It is Wednesday, the 12th of April, 2023. This is your midweek market snapshot. It will also serve as this morning's message. It is just 6 minutes before the open, and markets are rallying in the pre-market. We got a friendly CPI number, I will say. Particularly on the headline. It only rose month over month, 0.1%. The expectation is 0.2%. When we get to the core, however, which X's out food and energy, we're at 0.4% month over month, which was right on expectations, which is, an annualized rate of 4.8%, of course. There's a core that apparently Jerome Powell looks at that is core X housing, and it was anticipated apparently to come in at like 4.1%. It only came in at 2.9, so we're seeing some relief in the housing inflation metrics that they use for CPI. And the market again is looking pretty good this morning. It's given back about half of its gains. The S&P, a little bit after that news came out, was up 1%. It's up 0.5% now. The NASDAQ is up 0.2%, and it was up over 1% as well. So coming off the boil a little bit in the futures session. Of course, the cash session, we'll see. That's going to start here in 5 minutes. A few things I want to show you this morning, and I'm not going to keep you very long. I want to start with interest rate probabilities as reflected in Fed funds futures contracts. And those have come off the boil just a little bit, as I said in, I believe, yesterday morning's note, that on the jobs data last week, probabilities for a quarter point rate hike went from 40% to 70%, and that's the next meeting, which is May 2nd. You can see it dropped a little bit to 0.69%. That's what that reflects right there. The thing that I really want to focus on, though, is this graph down here. And that is essentially suggesting that Fed funds futures are pricing in 3 rate cuts by the end of January. And that brings the Fed funds implied rate down to 4.1%. from 4.83%. So that's big. And if that's what the market is really anticipating, let's say the stock market, and that's what it's rallying on, as I continue to say here, folks, that unequivocally is no reason to rally. To get that, we're in recession, and that's our base case. That's what our macro work suggests, is that the U.S. economy is very close to recession. And the problem with stocks holding up against recessionary forces is that recessions tend to do a serious number on corporate profits. And that's the orange line here. So this, again, is that chart that shows the ratio between leading economic indicators and coincident economic indicators. When it rolls over like this, folks, historically, that means we are about to enter recession. Okay. And what's it doing? It's rolling over like this. As you can see, S&P 500 company earnings have come down, but they are still massively elevated relative to what you tend to see when the economy is entering a recession. So we don't think inflation is the problem, although it's the focus right now. We think recession is the problem, and deflation or substantial disinflation that comes with that, and corporate earnings falling with that, as is what typically happens. And then, of course, that would mean stocks would need to come down to reflect lower corporate earnings. Now, this notion that stocks will start rallying hard when the Fed starts cutting. Sure, I get that. Here we are back in the mid-90s, right? Here's the Fed raising interest rates. Here's the market struggling with that. And here's the Fed with a couple of cuts, and there's the market off to the races, right? Here's apparently some inflation fears coming back, raising rates, a little bit of consternation there. 1998, Russian default, long-term capital management failure, pretty scary heralding time. Market went down on an intraday basis over 20%. The Fed cut in response to that. The economy started coming back. Inflation worries were coming on again. The Fed was raising rates again. You can see the market beginning to struggle right in here. And then the Fed began cutting, right? Well, here's the thing. So again, Fed began cutting, market rally. I can jump way over here to 2019. Fed began cutting, market rally right in here, right? But here's the thing we want to focus on. That's these red shaded areas, and those are recessions. If the Fed is aggressively cutting, as that first chart suggested they may be toward the end of this year, that is not good news for the market historically or typically, which is reflected in the last screen I showed you, which shows earnings dropping during a recession. So again, here's the Fed cutting, and here's the market falling. So I can't reiterate enough that the risk reward here, if indeed recession is on the horizon, is not one that would inspire us to take on more risk at this moment. Markets could continue to rally here, but we want to hedge. We don't want to go to our full equity allocation. We want to hedge the downside risk with options until we think the risk reward substantially improves, and we want to keep our non-correlated positions alive and well. And speaking of our position clients, since I normally do this on the written morning notes, with regard to the action so far this morning, of our 36 core positions, 32 of them are actually in the green this morning. Our Brazilian equity ETF, that's had quite the run of late. We've seen softer inflation prints in Brazil, and recall one of our reasons for our Brazil bullishness has to do with historically low valuations, historically high policy rate. They got aggressive right from the get-go, not to mention incredibly attractive dividends, but lower inflation suggests that there's room for the Brazilian central bank to ease. We also like that from a long-term viewpoint in terms of our bullishness over resources going forward. The second one is Albemarle, which is the U.S. lithium miner. It's up 2% so far in the morning. MP Materials, rare earth miner is up 1.63. Mexican equities is up 1.3, and silver is up 1.2, and then cybersecurity stocks are up 1.2. The losers are, AMD, the chip maker, is down 0.5%. Johnson & Johnson is down 0.37%. Our Ag Futures ETF is down 0.1%, and Consumer Staples is down 0.09%, and they've had a good run of late, as I've shown you on the economic update. Okay, so again, here I am talking a pretty bearish story, but our core portfolio is having a very nice run here of late. We've cut back some of our cyclical stuff. Those are still down notably from the day we cut them. We are overweight things like healthcare and staples in anticipation of recession. We've been scaling into our treasury positions, anticipating ultimately lower interest rates. So certainly we're not the kind of bears who have rushed to cash. So we're very diversified, and we are hedging with those options, keeping it as cheaply as we possibly can. But as we experienced big time in 2020, that's money well spent when we have a precarious setup like we do right now. Okay, so on to the technicals, and in the interest of time, we're just going to look quickly at the S&P and then at the NASDAQ 100 ETF. So the daily chart of the S&P 500, again, we have this flagging pattern. The bulls would love this pattern right here. It looks pretty good, and that could absolutely play out, right? We just think there's a tremendous amount of overhead resistance up there. So even if that does play out, folks, I don't think we're going to get to a bullish look on our momentum indicators, right? So again, I'm not complaining, as you might gather when I talk about how our core portfolio is doing. I'm just skeptical that rallies right here ultimately won't prove to be something that should have been faded. Drilling down to the hourly chart on the S&P 500, again, we broke out of this wedge pattern up in here. We had these bearish divergences. We're about up to those levels again. This chart's delayed by 15 minutes, and this will move here in a second. The S&P, it's only up 0.4% now. It was up over 1% in the futures market. It was probably up 0.2% at the open. So that, for whatever reason, that's coming off the boil a little bit. But we'll be right here hugging this line with really massive bearish divergences, quite frankly. So still not a great looking technical setup despite this morning's, we'll call it positive market news from the CPI print. And then the Qs, the QQQ is a symbol for the ETF that tracks the NASDAQ 100 index. And this is just a real bearish chart, the way we look at technicals. So again, your rising wedge, you broke out of that, you had your bearish divergences. Just about to get a sell signal here right now. The Qs have given up just about all of this morning's really big gain on the CPI number. It's pretty much flat, 0.12% is where it sits right now. And that's consistent with the technicals, but I did say, hey, I know technicians who are very bullish who think we're going to ramp up to there. And that just might, and it could happen in the near future. Right now, it's looking a little bit iffy. And we think there's just a lot of weight on this market right in here. Go ahead and look at the hourly chart here, and then I'll let you go. Real short-term consolidation right in here. So pretty ambiguous in terms of what to expect going in today, at least on the very short-term hourly chart. In fact, you could argue that you've got a little bullish divergence there in the RSI. So folks, I will leave it there. Hope you have a great rest of the day, and I'll talk to you again very soon. Take care. Bye-bye.